Hi, I'm Peter Rose, founder of Longwood Currency Trading. How big should your entry position be? How many lots do you go in with? How much money do you invest? It's a delicate question because when you're starting out trading and you don't have a lot of money, you're trying to make a lot of money. When you have a lot of money in your trading, you're trying to maximize the amount that you gain from the positions that you take without risking too much money. Now that sounds like more protective trading than it would be to seek the largest amount of profits. But you have to look at it this way. If you're trading 10 or 15 lots, and in my world, your leverage is not 200 to 1. So you need to be able to say, and have the capital. If you're going to trade one full lot, you have 10,000. If you have a 10 full lots, you have $100,000. So you're talking about substantial amounts of money, regardless of where in the spectrum that you are in your entry analysis. The problem with going all in with 10 lots at the open, if your bank size only allows you to trade 10 lots, is that if you are under my parameters, each lot's worth $100 a pip. You got a $100,000 account, so if you take a 20 pip entry stop, you've got you've got $2,000 that you're losing there. That's a lot of money, regardless of how big the bank size is. So you have to say, how long have I been trading at the 10 lot size? Do I want to go in and risk $2,000 each time? If you happen to run in, and this is the way I look at it, if you happen to run into the 6 statistical losses in a row that you would have if you're trading actively, now that could be, you could be making 5 trades a day, or you could be making 1 trade a week. When you reach a statistical sample size great enough, 100 trades, 50 trades, something like that, and calculating something like this, you're going to find that there's a certain number of trades where you're going to experience 6 losses in a row. So if you take that example of the 10 lot position going in at entry, and you take a 20 pip loss, you're losing $2,000 each time. That's $12,000 that you're going to lose. That's the value, more than the value of 1 full lot. So now instead of being able to trade 10 full lots, you're down to 9. And that's why when you get up into the larger lot sizes, you want to break your positions down into building a position, and then when you go into the position management phase of your trading, then you stage in after that the positions, so that in building the position, you enter with like, let's say you have a 10 lot position, a 10 lot capability position. So in that case, maybe you go in with I don't know, let's just say you go in with 3 lots, and then you stage another 3, you build with another 3, so you get 6 lots in your entry work that you're doing, that you've put in. You've got 4 lots left to stage, and you only start staging after you transition from the entry phase of your life cycle of that position into your position management. You have entry phase, position management, and exit methodology. Those are the 3 phases, or the 3 stages, the life cycle of a currency position. If you don't understand that, go back in some of my videos, and I talk extensively about how I came to break that up into 3 areas of concentration because of my software engineering background. Regardless of all that crap, if you're sitting with a potential 10 lot position, you have to ask yourself, do I want to enter with 10 lots? Well, probably not if you're coming from trading 3 or 4 lots, and now all of a sudden, you sell a house and you have a ton of money, and now you're able to trade 10 lots. So if you jump from 3 lots to 10, if you lose at 30 bucks a pip, 20 lots, you lose $600. If you do that at the 10 lot position, you lose 2,000. So you have to say, yeah, I'm jumping from this statistical loss amount to this loss amount, and even though I have the money to take care of the fact that I lose 6 times in a row, whether that's at the 3 lot position or the 10, it's a dollar value that you're looking at, and the dollars are the dollars are the things that you have to replace. So from a percentage standpoint, bringing that money back is relatively difficult if you've really maxed out that account, because you're losing, in the case of the 10 lot position, you're losing 1 lot. You're losing 10% of your entry power in taking that $2,000 loss. Well, you could say 10 pips and make it 1,000. Doesn't make any difference. It's a lot of money in relationship to the amount that you would lose under those six statistical losses if you were trading with a $30,000 account, trading 3 full lots. So my philosophy on all that, if you've been watching my videos, is that up to probably the 3 to 5 lot position, depending on how long you've been trading, you're in an all-in, all-out type situation, because you're trying to make money. You can't take a 2 lot position with an average win of 10 pips or 12 pips, and let's say you equal that with a 10 pip stop. You're a 60-40 trader at 20 bucks a pip. Yes, from a mathematical standpoint, you'll work out fine, but from a practical standpoint, and obviously if you're trading $20,000 account, you're still a relative beginner in your trading forex trading journey, and so you have to be cognizant of what you're doing, those steps that you're taking in order to maximize the amount that you're trying to win. What that forces you to do is to become really good at your entry analysis, so that you are not trading at 60-40 when you're faced with the positions of trading a $40,000 or $50,000 account and going all in, all out, because you're trying to make more money. You're trying to get that account to grow. If you're trading under reasonable leverage, so you don't blow your ass out of the water, and you're trying to replace your job income, what's your job income? Could you replace a $30,000 job income on a $50,000 trading account, trading 5 fulls? With experience, probably we could. Could you do that on a $10,000 account? Probably not. You'd have to make 300% on your money, right? So you have to be realistic about things. And if you're making $50,000 a year, you're not going to replace it on a $50,000 account. You might, if you're very, very careful, and you really, really, really know what you're doing. In the case of Larry Williams, a famous trader, his daughter a couple of times took a $10,000 account, ran it to 6 figures a couple of times, I think 18 months or something like that. So it's possible that you can do that, but look at the skill level that you have to have. I mean, just the fact that you've been driving around in your car for 5 years after getting your driver's license doesn't necessarily indicate that you can go in and win a stock car race or drive an Indy 500. You just don't have the skill for that. So you have to look at trading in these realistic terms, and the likelihood that you're going to lose 6 times in a row is very high. So you have to account for that in how you're judging the number of lots that you are capable of trading, and how you're going to risk all of those up to a certain point of lot size, where then you start building your position, and then eventually into staging. So you go through those positions of all in, all out, in my way of thinking, up to until you can trade 4 full lots. So if you trade 3 full lots, you're all in, all out. What's nice about the 3 lots, that's kind of a sweet spot for me, or I found that to be a real nice sweet spot, a learning spot for me, as I got into that level in 2021. I think I was trading position sizes 1 to 3 lots, something like that. And then when I moved into 2022, I was solidly trading those 3 lot positions. I was comfortable with that 3 lot, and they were all in, all out positions. So, you know, if I'm going to lose, I'm going to lose $300 to $600, depending on where that stop level is. And I had a really good win to loss ratio. I was running at about 70% win to loss. So when I went into 2022, I had the confidence of all in, all out, but not so much all in, all out. It was my win to loss ratio, which meant that if I screwed it up pretty bad, I could make that back. And that gives you a sense of comfortability with your trading that allows you to trade up to that 3 lot position, all in, all out. When you get to trading, and you could do that maybe 4 lots. Usually the break point that I found was that 5 lot position. And between 5 lots and 10 lots of trading, I broke that up into building the position. Building the position is different than staging in. There's a certain point where you transition from entry analysis into position management, right? And that's, I define that when I'm working with a student. This is the dividing line between where you move from entry to position management. And it's at that point that you better have your position built before you go into staging. The position built theory is that if you build your position and hit your profit target and you're holding it and then it starts to slide back and you exit, you're exiting with some number of average pips such that the lots that you've built the position with up to that point are sufficient to pay you enough money divided by the amount that you risk. In other words, if I make $300, let's just say I build my position on a 3 lot position. I go 2 in and then build with another one before I go to position management. It turns around and goes against me. I get out. I've got 3 full lots, $30 a pip. I make 10 pips. I've got $300. So $300 divided by 30,000 is 1%, right? And so that's a pretty good return. And so you're trying to build your position such that if you have to get out, you've made enough money to make the day worth your while. I mean, if you make $300 a day, that's $72,000 a year. Come on, let's be serious about how we're working with these numbers. Oh, you're not gonna make any money at $300 a day. Oh yeah, you are. So when you are looking at the prospect of moving from trading all in 3 lots, all out 3 lots, all in 4 lots, all out 4 lots, and you get to that 5 lot position, you start saying, maybe I should come in with 3 and add 2. Let's say you're trading 5 lots. I'll come in with 3 and I'll add 2. Or you go to 6 lots. Oh, maybe I'll come in with 3 and add 3. Or maybe I'll come in with 4 and add 2. You never want to go add 2, come in with 2 and add 4. You don't want to reverse pyramid that. And if you don't know why, probably ought to go back and start doing some real good study, because you're going to get your ass handed to you. So when you get to that 8 lot position or 10 lot position, now you've got enough to build maybe 3 or 4 lots in your building phase, and then you're going to stage the rest. How many times statistically is price going to run on you so that you're going to start staging in those other lots? Not very often. And so you got to make sure that you're really solidly foundation in building your position, and you're not stacking getting the average value, position value of that building phase, such that when the price comes back against you, that you only make, let's say you're building on those the 3 lots, which you wouldn't be doing, that you make $100, because you're going to lose a lot of money on the last lot that you put in, and then the next one is the only one that pays you. So you have to be you have to build your skill level up. I'm not talking to a beginner here. If you're just a beginner, these are issues you need to know about, but you're not going to be trying yet. So when you're trading 1 full lot, 2 full lots, 3, 4 full lots, you're just going all in. I'm going in with 3, I'm going in with 4, and I'm coming out with 3 or 4. I never stage out of a position. In other words, I don't ring the cash register, because that reduces my gain from the standpoint of how much I risk. It just throws your numbers way off. It's just crazy. It never hurts to ring the cash register. Yeah, it does hurt to ring the cash register, and particularly when you don't know what you're doing, because it builds bad habits. It teaches you to look when to get out instead of when to add. It's a bass-ackwards way of looking at things. If you're trading $1 million account, yeah, why don't you get out and make $40,000? You're fine. If the thing continues to run, yeah, you could have made $80,000. Instead, you're only going to make another 30. Well, you know, that's okay. But when you're trading 5 lots, 10 lots, 20 lots, and look, I'm trading 20 lot positions right now. That's not the situation that you want to find yourself in. So you look to the future as to how you're structuring your trading based on what's a good daily amount that I need to hit. So if you're trying to replace your job income, and you're saying, well, I'm going to make $300 a day. Well, how are you going to make $300 a day? Well, it's you make 10 pips on a $30,000 account, right? That's $300. That's not really too tough, but you're not going to do it on a daily basis. You're not going to make that 10 pips daily. You 60-40 trader, again, as you're starting out, you shouldn't be playing with a live account unless you at least have proven yourself out at the mini account level live at 60-40. I mean, you don't start stepping up your game until you're at least 60-40, because you can win at 60-40. You can win at 55, but it's really hard. You need 60-40, and that's when I'm working with somebody. The process is try to get them up to 60-40 within about a 3-month period of time by following some really rigid risk management guidelines. And one of those guidelines is you ain't staging, you're not compounding, you're not doing any of that crap. What you're doing is you're going all in and all out, because you're going to learn how to trade. Because if you don't know how to trade, you're not going to be able to figure out how to stage correctly. You're not going to be able to figure out how to compound. You're not going to know how to allocate your money between those stages. You're not going to know how to allocate your money in a build situation. Your greed is going to exceed your fear. And it isn't that you want your fear exceeding your greed. It's just that the fear is not playing a large enough component in your trading until you get to the point where you're good enough to say, I'm going to go all in, baby. And even when you go all in, like I did last year in 2023, I was up 91% on my risk in the last couple of months of the year. I saw a great position. The volatility was there. I went in a little heavy. It went against me a little bit. I stayed. It went back up. I staged in a little bit more too soon, out of my rules. Staged in again, went back way against me. I waited, it went into my favor, and it really started to scream. I thought I was there, and I went all in heavy, and immediately turned around and went a couple hundred pips away from where that was, just, and you know, I got stuck. I ended up 46% ahead on my risk, but you see the difference in how badly you can get hit if you stage in at the wrong time. The theory of the trade was fine. I just didn't get out when I should have gotten out, and I ended up taking a really bad hit. But I still made 46% on my money. But when I came out of 2022, as I was mentioning, I was trading comfortably 3 lots. So as I went into 2021, as I went into 2022 trading, I started trading 3 lots, and then after a few trades at the beginning of the year, just to get loosened up, I was trading 3 to 6 lots. I went immediately to 6 to 8 lot positions, and then within I think it was 5 or 6 months, I was trading 15 to 20 lots, and at the end I was making some 25 lot positions. That isn't all the money that I had in my account, but that's as far as I was comfortable in. That's part of my risk management. I don't trade my full stack. And I did get into trouble a couple of times where it backfired on me, as I said, in 2022, because of that rapid escalation in the number of lots that I was staging in before I had built up enough buffer to withstand a major loss. Going 5 months from trading 3 to 6 lots to trading 15 to 25 lot positions, and then getting 4 or 5 losers in a row, and then overestimating where I was in the cycle of the trade, and you start losing a lot of dollar value. The percentage isn't really that big of a deal, because I had made so much money that I probably should have had more of a fear of losing that some of those gains than I did. I was more interested in I had a huge profit target that I had lined up, and all the factors lined up for me able to achieve that, and it didn't work out. So I'm not going to beat myself up about it. It just didn't go right, and I made 46%. Hey, if I wouldn't have been 91% ahead and I would have ground my way through, and I would have said, geez, I started with 3 to 6 lots, and I'm trading 25 size positions toward the end of the thing, and I'm up 46% on my average risk. I'm doing pretty good. So I think I know a little bit about what goes on in these different lot levels that you're able to invest in your trading. Is you just be aware that up to a certain point, you're all in, all out. You get to another point, and then you're in the building phase, the position building aspect, and then you're going in with part of that and then adding a little bit to it, and that has to happen before you get to your profit target. And the last one that you put in can't be 3 pips away from your profit target, because your profit target is generally, I always say I'm trading 5-minute charts with a 5-period ATR. So I can look at the chart and say, okay, this has only got 15 pips, and I'm going to run into some support or resistance level or structure, or there's going to be news release or some shit going on, and so I don't want to be going in there, because just a small pip move backwards will take that position out, and that's a big loss that's being clipped away from the money that I had made. It was just stupid to do that. So you've got to figure out the math between what you enter with, what you build that position with, and where your profit target is, your theoretical profit target. And if the position goes to shit and that thing starts to come back down, you've got to have that last build, because you're not building 3 times in between your entry and your profit target. You have an entry and 1 build. That's all you've got. Because you want to get your chips on the table. If you're trading 5 lots, you don't want to go in with 5 full lots, because if it goes against you, it's $50 times whatever your risk is, 20 pips, $1,000. So you don't want to do that. It's a function of risk management that I'm concerned about trying to share with you here, in that you have to understand how the numbers work in this stuff and what the probabilities are for extended losses in relationship to your win-to-loss ratio, because that tells you how difficult it's going to be for you to make those losses back in order for you to continue on and to profit. You know, if you lose 50% of your account, it's going to take you 100% against the remaining 50% to get to even. Well, if you think that that's going to happen, you're sorely wrong. Because if you were trying to make 30% a month on your money and you lost 50% of your account trying to do that, and you don't know what you're doing, you can't even make 30%. How are you going to make 100% back? It could take you 3 years, and then you only have to make 30% a year, right? I mean, how much time do you have? I'm 73 years old. I don't have a whole lot of time to do that. So if you're 20 years old and you want to take 3 years to make that back, that's fine. You can do it. You go ahead and do that. But is that smart? No, that's not smart. So what I'm trying to do is show you how to get to the point where you're making as much money as you can out of the size of the bank that you have. So between 1 full lot and 5 full lots, you're all in, all out. From 5 lots to 10, you're going to be building that position. Let's say you've got 5 lots, you're going to go 3 and 2. As you go to 6 lots, again, however you want to do it, you've got to do that between your entry level and your supposed profit targets, so that both of the lots sizes that you've built the position with are in profit when you pull the trigger to get out of that trade. If you're not doing that, you're gonna kill your win-to-loss ratio, and you're not going to have the money that you need to make. In other words, you don't know what you're doing. If that happens, you don't know what you're doing. And so to dump more money into the account and say, oh, I fucked it up between 40 and 50,000, I'll put $100,000 in the account and I'll replicate all this stuff and I'll be fine because I'll have all this other money. Yeah, but you don't know what to do with all that other money. You're going to be trying to stage in 10 full lots in your build phase, and you're going to be in trouble. If you don't have 2 times the build, then you shouldn't be thinking about staging, because the loss when you lose out of that build stage could take the value of your account down so well that all of a sudden now you can't trade that extra lot or 2 lots. So be very, very careful. That's all I'm saying. Hey, if you got any questions about this, I mean, this is a course that I offer that just in this area. There's 70 or 80 pages in the manual that we go over this stuff. But I do, in the beginning parts of the training that I give, I allude to all this stuff as I'm doing on this video, except we have the ability to exchange thoughts about it and what your particular situation is. But if you have any general questions on that, throw me an email. I'd be happy to see if I can help you out. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.